Last week's surprise halt in interest rates. This week, I want to crunch numbers and see if we have actually peaked, which is the question on so many people's lips at the moment, and also when are interest rates likely to drop. And what I'm also going to show you is why this is probably the wrong question that we should be asking anyway. Let's get on with it. Hey team, I hope you are fantastic. It's Rob Stewart with you. It is, I forget what day it is because I've been traveling for the last couple of days. I've been away for the last week or so. I believe it's Wednesday, about to be Wednesday evening. Welcome to the live stream. If you're watching on the replay, welcome to the replay. As always, as we go through this, please ask your questions. If you're on the live or the replay, get them in the comments. I'll always come and answer them for you. And today we're going to talk about interest rates. And we're going to talk about what is going to happen over the short-term to medium-term future of interest rates, because since that surprise rate hold of last week, which I know is old news now and everybody's talked about it, the question on everybody's lips is, have we peaked? Okay, and when will interest rates go down? So what I want to do today is go through some of the data and see if we can make informed discussions, decisions, create hypotheses of what's going to happen with interest rates over the next 3 to 12 months. That's what I want to do. If you're new to the channel, welcome. I know we are still having many more new people to the channel, so welcome. These live streams are when I come live and talk about the data to get through the headlines so we can make better decisions as investors, or if we're just buying and selling property or investing in other asset classes as well. So that's what I'm going to do. Now, firstly, if you can hear me and see me as we're on the live, please give me a thumbs up and type something in. I see we've already got some comments in already, which is fantastic. Excuse me, sorry. This is what happens when when you're behind the drag curve a little bit. So without further ado, let's crack straight on with it. And I haven't got my iPad today, so we're going to have to go through this on the slide deck on the laptop. When will interest rates drop? So before we crack on and look at the data, I want to talk about something called cognitive dissonance, which is a phenomena where we tend to stick with our internalization in terms of our decision making, and we internalize decisions. And when we do that, it's very difficult for us to change our minds on what's actually going on, even presented with contrary data to our sort of belief system. We choose to believe something different. Now, the reason I'm talking about this, and I talked about this a couple of months ago, is when I see narrators or people on social media or mainstream media talking about things like interest rates, how that's going to affect the economy, how that's going to affect property market, a lot of people have internal belief systems, okay? So you generally have people I call like the property bulls, for example, who think property is always going to go up. You're going to have the doom mongers, people who think that it's always going to crash, and then a whole spectrum of people in the middle. So what's important, I feel, is to come to this with an open mind, look at all the data that is out there, and then use that empirical data, okay, to drive our decisions, rather than trying to use it to back up a narrative or a hypothesis that we may have. I personally like to look at a quantum of probabilities. So go, right, what could be happening right of arc? What could be happening left of arc? What's the most likely probability out of the range of possibilities? And base my decisions on what I think is the most likely, whilst risk mitigating what could be the extremes. And that's something that I try and achieve on this channel. So I think that's an important part to note. So last week, and you know, one of the reasons I say this is everybody last week was, and myself included, by the way, was talking about we're probably going to get a rise in inflation. And a rise in inflation, almost certainly we're going to get a 0.25% base rate nailed on last week. That's what we were talking about. Now, what then happened was something that nobody predicted, which was actually inflation came down. So all of the predictions, which could well have been leaked, right, to frame it more, more nicely for the government and the Bank of England, everybody is predicting it's going to go up to 7.1% from 6.8, 6.9, up to 7.1%, and it went down, and that move down was actually much better than everybody thought, even though it was a 0.1% move down from the month before, because everybody thought it's going to go up. It's actually good news, okay? And in the light of that, the MPC met last week and decided to hold interest rates. Now, when I was researching this earlier today, this live stream, I saw that out of a poll of 66 economists and analysts last week, the day before the Bank of England base rate, 65 of the 66 said that interest rates will go up 0.25%. So the point I'm making here is that things can change very quickly. Things can change based on contrary information. We could get contrary information or data that means we need to alter how we think about what's going on. Okay. So I thought that, you don't get much more cast iron than that 65 out of 66 thought that interest rates are going to go up last week. Now, when you look at it, when you look at the vote, it was split almost 50. Well, it's 50-50 split before Bailey put his casting vote, and Bailey has the casting vote as the chairman, and he voted to pause interest rate rises. I suspect that with a vote as split as that, we're kind of reaching the top of this cycle, right? And we're now seeing a very fine balancing act. But I suspect the casting vote went to send a message out to, I guess, mass media, everybody else, that we're not going to carry on going up forever. People are starting to feel the pinch. So I almost feel it's a message that went out. There's like, sort of calm down. Let's not have any sort of social unrest and all that sort of stuff. We need to take a foot off the gas for people, just have a bit of a breather with what's going on. That is my suspicion of why it was paused. Now, it doesn't mean it's going to carry on like this next month. So we're going to look at the date of that. But as we know, the interest rate was paused, and a lot of people are now saying that's it. That's the cap. I've seen a lot of commentators on social media, especially the property bulls, and this is why I talk about this cognitive dissonance team. We need to understand this cognitive dissonance. All the property bulls are immediately out going, that's it, we've peaked, it's not going to get any worse than this, and it's going to start coming down again. Failing to understand all of the macroeconomic factors that are going to be going on even over the next 12, 18 months if it doesn't go up again from here. Because something that's really important to stress is the lag in the system. We'll talk about the lag in the system a bit, okay? Everything is creaking at the moment, probably from the effects that were going on from the rate rises last year in 2022. When you talk about macroeconomics, it is generally accepted that an interest rate rise will take 12 to 18 months to filter through the system. So right now, we are having those interest rate rises from summer 22 filtering into the system. So the interest rate rise has been happening this year, even a month ago, are not going to be felt into mid-23 going into 24. And that is why a lot of the decision-making from things like the MPC, okay, are very short-term thinking decisions based on data that's probably almost a year out of date already. So it's a very difficult job to do. But what is clear is that things are starting to creak, right? And that's obvious. So let's have a look at where we are with the economy. Because what I want to do is when you see the split, we've got two separate competing factors again here. We've got the economy, i.e., are we going to go into recession? Do we trash the economy by continuing to raise the interest rates? Versus the inflation, right? That's on the other side. We have to control this inflation because everybody hates inflation, right? The government's big pledge is to get rid of inflation. So we've got these two balancing acts, and the two are sort of, pulling against each other at the moment. And we're reaching that point where there's sort of an equal pull going on, which is why we've seen that split down the MPC, that pause this month. But I want to look at both of those factors to try and make an educated hypothesis prediction about what's going to happen next. Okay, so let's have a look at the economy. By the way, let me just come off this a sec. Somebody put in a comment the other day that they noticed, they watch a lot of my live streams and really enjoy the data and the analysis, but noticed that most of the things I talk about are negatively skewed. I would suggest that I am trying objectively to cover the data and put what's out there. I don't feel there's a huge amount of positive skew out there right now, and that's just my genuine. And I would say I'm probably slightly negative bias, negative confirmation bias with how I look at data and look at sort of big picture things due to experiences I've had over the last 15 years of being in this industry. I generally have a negative bias towards it with my decision making. So I would say I'm quite risk averse now, didn't used to be, and more conservative. So I think I'm always challenging myself to go, right, where's the positive in the data? So this is why I want to have a look at where we are in terms of the economy, so we can see what there is positive. So first of all, the narrative out there is that the UK economy is surprisingly resilient, right? And I can't zoom in on this team because I haven't got my iPad. This is on my laptop. The narrative is that the economy is proving ridiculously resilient right now. Now, if we look at the right-hand side of the graph, by the way, this is the dark blue line here is what we've been charting for however many years. The light blue line is this Blue Book 2023. If you've seen any of my stuff before or some other commentators, you know that we've changed the goalposts in how we calculate GDP, and they found a whole load more GDP, which will be rolled out over the next couple of months. So expect our GDP to actually go up next month as they roll it out for the last year or so. You can see that we are pretty much flatlined, okay? So growth up to COVID, massive spike down, kind of V up with a little sort of blip there, and then we've gone into flatline. And really, when you look at that, it's a flatline trace, a very weak heartbeat, right, in a flatline trace, but we're not going up anywhere. So the economy is not nosediving, but it's also not growing anywhere. This is not a good thing for economy, by the way. Now, if we look at month by month, we are technically avoiding recession because we are in this yo-yo flat line, sort of beep, 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 beep on a flat line. So we're going up, down, up, down, up, down, which isn't taking us anywhere. There's no growth, but it's also not consistently going down. So we could probably almost have, the same net and have a couple of quarters of negative growth and therefore be in recession. But this is not a particularly healthy heartbeat, right, if you like, for an economy. We are flatlining around a mean. This is why I think the economy is not in as good a state as people think. People don't think it's in a good state. I don't think anybody is out there trying to paint a picture that we're in a great state. What people are saying is we are resilient, and it's being resilient against recession. I think that's creating a mainstream media headline that actually the economy is doing just well, just fine. If we look at quantitative easing since it started really in the financial crisis of 2008, this graph shows the UK government's quantitative easing efforts. UK government. Let me rephrase that. Not the UK government, the Bank of England's quantitative easing schedule. And you can see we've had 4 tranches, if you like, of quantitative easing. The first in the financial crisis of 2008. So kind of we went printing money in 2009. The next one there was like a double dip scare of that. People thought, oh, okay, we've come up out of it. We're dipping back in. Let's print some more money. We had a little print with Brexit to sort of steady nerve the Brexit. Then look at that spike, right? If I put the mouse on here, the cursor on here, you can see this spike here is when COVID hit, and the QE that went on when COVID hit eclipsed everything else. I think if you look at that, it's probably more happened in post-COVID than those 3 previous tranches, past the financial crisis of 2008. You'd have thought that would stimulate the economy. All of this, basically free or very cheap money being pumped into the system, right? That should surely get the economy going somewhere. But let's just re-look again, right, at this graph. So if I put the cursor over here, this is 2008 crisis. You can see we had the dip in GDP, and then we went on this money printing, and we've stimulated growth. We had that double dip scare. You had Brexit, growth the whole time. COVID hits, flatline, even with more QE than all of the rest of those 3 things together. It's not stimulated any growth in the economy. It doesn't feel like a particularly healthy thing. So all that QE has done, right, is stabilized it to stop it from crashing. If we look at this graph, now again, I know this is difficult to see, team. I'm sorry, I do apologize. We cannot zoom in on this. If you were to look at the very right-hand side, this graph is GDP per capita in the UK. So effectively, rather than overall country GDP, it's GDP per person in the UK, and it's actually dropping. So those GDP figures are probably flattering somewhat based on the fact our population is going up and the amount per person is coming down, which means, per person, we are dropping. That, again, is not a particularly healthy graph to be looking at. So real terms, flat line across a mean, per person, we're actually dropping. That's not a healthy economy. And what the bank is clearly worried about now is we're seeing a lot more signs of this economy creaking as these interest rates come up. Economy creaking, and we'll relate the economy creaking or the economy and recession to the property market in a bit. But they are clearly starting to get worried with what's going on. Let's just look at some of these leading indicators of the economy right now. This is all stuff I've covered over the last couple of live streams, so I'm going to go through it quite quickly. This is vacancies for UK businesses advertising for job roles. So vacancies are dropping as a leading indicator. That's a pretty good leading indicator of what's going on in UK businesses. If we look at the latest unemployment data, we have another uptick in unemployment. We're up to 4.3%. Again, historically low, yes, but we're not comparing apples with apples when we look at, unemployment in the 80s and 90s and even noughties to now, because it's different yardsticks. All we want to look at is the trends here. Historically low, but trending up, right? So vacancies trending down, unemployment trending up, the amount of people in employment is trending down. I want to give you some anecdotal sort of storyline here or narrative about what I'm seeing on the shop floor. And one of the things I love about owning my group of other businesses outside of property, like trading businesses, is kind of seeing what's going on in different industries. And from my scaffold business, we're kind of at the shop front of UK construction. Okay, so as things coming up the ground, they need scaffolding. So we're there at that stage of UK construction very often, seeing what's happening. This is a site that has just completely imploded that we were on. It's quite painful for a lot of people, including ourselves and our company. We're probably going to be losing money on this due to the main contractor going insolvent, which was Buckingham's. So Buckingham's is in, I think it's number 30 in the UK's largest construction companies, doing major sort of infrastructure. They do a lot of stadiums, things like that. They went bust or went into administration a few weeks ago. This is actually the second time a subcontractor on this project, which was the Anfield extension project, has gone under. So Buckingham's are the main contractor. Let me just come off this second. Buckingham's are the main contractor. They were originally, they then basically package out pieces of work to other large main contractors. We were subcontracting to a company last year called ST Samuels Special Projects, who went into administration in end of 2022. So that was the first one that went. ST Samuels got replaced by another subcontractor, which we carried on working for. Buckingham's has now gone under, and I would imagine Buckingham's going under is going to set off a domino effect of supply chain going under. So I know the people we've been subbing for, Allied, are owed a 7-figure amount. Probably not going to get it. That again will sort of set off more of a domino. Now, why did this happen? That sort of news article I put there. Buckingham's are citing one of the reasons is sort of cash flow and the very rapidly inflationary effects on things like labor, materials, caused by things like the Ukraine war, right? So we're seeing this a lot in construction. You've got major projects, major infrastructure projects, major developments going on, which have tied in price points from pre-high inflationary spikes. They're on and now cannot deal with the issues in the supply chain, the issues with inflation, and it's causing cash flow issues that are putting businesses under. Now, construction is a historically tight margin industry anyway, so it's clearly affecting construction a lot more than maybe, let's say, service-based, for an example, service-based industries where you only got wages, not wages, and materials. So that's some anecdotal evidence of what's going on right now, and I suspect this is going to continue. So those headline figures, when we look at the stats for things like the economy and GDP, we're looking very high macro levels. This isn't really showing what's going on the shop floor with a lot of companies, a lot of businesses. So I think it's really important to stay looking at what's going on with businesses. You saw Wilco has gone under. There's stories every week of more and more who are struggling. So just to sort of zoom out on that and go economy as a whole. The most positive thing we can say there, if we're looking sort of right of arc positive, left of arc negative, the most positive we can say is we haven't gone into recession yet. That's about it. That's about all I'm finding in terms of the positives of where we are with the economy. And when we follow it through logically, we would expect this, by the way, because the interest rate has gone up from 0.1 to 5.25 in a year and a half, whatever it is. That's going to cause issues. And due to the lag in the system, we're not even at the end of it yet, right? So a lot of people are saying the Bank of England have already gone too far with the interest rates, and that's because the last, 1.5% they put up are not even being felt by the system yet. These are going to be felt over the next 12 to 18 months. And I actually agree with that, seeing what it's like on the shop floor right now, specifically in the construction sector. So that's the economy. Let's see what it's doing in terms of strain on households, so consumers directly, what's been going on with the interest rates. So here's an interesting graph that I found, which shows the amount of change in mortgage interest payments. So you can see we're now effectively, and this is as of this month, seeing the largest change in interest rate payments probably in history. We're sort of I'm just trying to look at the scale of this. Sorry, that's the 80s is this spike on the very left hand side. We're now exceeding that. So this is a huge change in a very short time period of people's mortgage rates. And again, just to stress the fact, there's still lag in the system. We're not there yet. There's still over 1 million people I think it's 1.6 million between now and the end of next year who are coming off fixed rate mortgages, right? So this is going to get bigger and bigger, and more people are going to get affected by it. This is a big issue with people. So last week I talked about CPI, and the fact CPI came down by 0.1%, and everyone's going, look, this is fine, it's great, it's coming down. The CPI basket of goods is potentially not the most representative example of exactly what people are spending their money on right now. And I would suggest most people, their biggest expenses are probably their mortgage, if they are coming off a fixed rate mortgage, or their rent if they're in rental, because we've seen double-digit rental growth as well. Now, this isn't necessarily being captured and filtered through from that CPI basket of goods to the actual strain on people's ability to live. When we look at this, this is old now, right? And I haven't been able to find a more accurate and up-to-date one, but I'm sure something we publish soon, because generally these sort of figures come out quarterly. When you look at the outflow of savings for consumers, for everyday people, we're seeing this huge spike down in people's savings outflow. So all of that money that people have been saving in this, liquidity event over the last few years post-COVID, which, by the way, people have been saving a lot, and paying down debt, which is great, but it's now reversed, and we're seeing the saving outflow again because of how difficult it is for people. So regardless of what CPI or CPIH is telling us, the strain on people's incomes is very real and getting worse and worse and worse. I should have zoomed in on that one. I should have cropped that. If you can see the light green line at the top of this, now this is specifically for buy-to-let mortgages. I think it's more instantaneous with buy-to-let, because buy-to-let landlords have to be able to service their mortgages effectively from rent roll. It's kind of showing the same trend in terms of residential mortgages, but this is the latest set of data for the arrears. So this is Q2 2023 arrears report. You can see that light green line of people who've gone 2.5% to 5% arrears on buy-to-let mortgages, and that is starting to spike up now. So people are really struggling to cover those mortgage payments. Why am I talking about this? Why am I talking about mortgages specifically? Well, we're going to relate all of this to the housing market in a little bit, because primarily, we're not here for an economy lesson. We're here to go, what is going to happen with interest rates? What is going to happen to the housing markets, right? How is this going to pan out? Because we are still out there. I still hear people going, property market is not dropping. Why is it not dropping? I don't get it, but just look at all the leading indicators of what is going on. Okay, these arrears are starting to go up. Okay, so that's what's going on out there at the moment. The economy is not looking great. People's personal finance is not looking great, offset slightly by higher wage growth, right? But until last month, the wage growth for the last 12, 18 months, 2 years has been lower than inflation. So only now we're getting to real-time wage growth, and there's quite a lot of catching up to do for people, even though their nominal wages have gone up, to be able to keep in line with all of the increases that have been happening. Okay, so businesses and the economy is struggling, people are struggling, and now we're in this, as I said earlier, this sort of pull effect of inflation versus recession. Which is the worst at the moment that we've got to deal with, right? Is inflation the worst? Is recession the worst? And clearly over the last sort of 18 months to 2 years, the Bank of England has been saying inflation is the worst beast that we have to fight here, right? This is what we need to get rid of. Right now, what they're saying is inflation was up here, recession down here. Now we're kind of coming like this, right? So we're kind of coming on parity, which is why we've had this split down the vote, and why we've held interest rates. Because if we just carry on racking up the interest rates, that risk of recession is going to go much higher than the inflation. Because the inflation will come down quickly, but we'll go into recession and break the whole economy, which maybe they want to kind of do anyway or need to do anyway. So that's why we're in this sort of push-pull factor right now. So let's look at inflation. So we paused with the interest rate rise because inflation has come down quicker than people anticipated. This is a good thing, by the way. So let's talk about the positives. Inflation coming down quicker than people anticipated is a positive. However, it's still at 6.8% CPI, 6.8%. Sorry, 6.7% in August. So it came down from 6.8. So 6.8 to 6.7, which is still 3.5 times targets. Now, I know 2% target is an arbitrary figure, but it's still 3.5 times target. So it's coming down quicker, still high, and last month it came down by 0.1%. So all of this sort of optimism has come down by a 0.1% decrease month on month. CPIH did the same, 6.4% to 6.3%, and the core CPI actually came down by 0.5%, quite a decent amount, 6.4 to 5.9. I covered all this last week and the week before. I just want to refresh and give you some highlights of where we were at that inflation. When we look into it, though, and this is the worrying thing for me, this is why I do not feel this story is over yet. I do not feel inflation is conquered. And when we talk about that fight between inflation and recession, right, even though the narrative is we're doing this, actually, are we still here? This is what we need to make the decision, because when you look at services fell, but goods went up last month, 6.1% to 6.3%. And the big one that I think is so important for the housing market is the owner-occupier housing costs went up from 4.5% to 4.8%. So of the three metrics there, services, goods, owner-occupier housing costs, two of them rose last month. One of them dropped. And it's trends we care about. So we need to look at this data and go, right, if these trends continue, what's going to happen? One of the main, sorry about the scrawling, this slide was taken from when I did the live on the iPad and scrawled all over it. One of the main things that we saw trend reversal is cost of fuel, cost of motor fuel specifically. We've seen the rise of Brent crude again over the last couple of months. We've talked about it. I've been talking about it for 2 or 3 months now, how this is going to filter in the supply chain. This is on the right-hand side. You can see pointing, whichever right is for you. We've got that price of crude filtering back into the system. This almost inevitably will feed into next month's CPI and going forward. Okay, so the month we just had has had some offsetting factors, but we do have that cost of crude going in. Right, again, if you look at this is owner-occupier housing costs in the bottom right. The maroon. Maroon is, so the bottom part of that in the right-hand side of the graph, the maroon bar charts are the owner-occupier housing costs. The sort of light greeny, snotty color is rent. These are going up as well. So cost of fuel going up, going to supply chain. Mortgage interest payments going up, rental going up. These are all going up. These are all going in the wrong direction for us, which is why I believe CPI or inflation is not conquered yet, and we could see a sting in this tail potentially. This is the price, spot price of Brent crude I took today. Now nobody's forecasting that Brent's going to go 120 a barrel, 130, 140, 150 a barrel. But I looked at this a month ago when I talked about how I believe the cost of fuel oil, it's going to be a factor that is out of our control. And we were down in the mid-70s at that point. We were sort of down here when I started talking about this. I said, look, this is a volatile commodity. If this goes up, this could go into the supply chain. And we're now into sort of about 95 a barrel. So very fragile, and actually another supply shock could send it, well over 100 again. You can see over here, we've got sort of, that's when it went to 120 a barrel. If we're getting back to 120 a barrel, I'm not saying it will. Current trends is going up. It's not going to carry on going up, but some sort of supply shock could make it go up, and that's going to feed back in as well. So that's something that we need to be cognizant about. So we've got trends, oil going up. That's going to go into the CPI data. Housing going up, goods going up again. Okay, services coming down. We'll see what the trend does this month. But again, as I said, I want to stress there is lag in this. There's lag in all of this. So the things that we are doing in terms of interest rate rises to combat inflation, okay, are not actually even going to happen until 12 to 18 months down the line, which is why it raises that contra question to go, even looking at those trends, have we done enough right now? And should the bank raise the interest rates again? Because if they raise the interest rates again, is it going to have any impact on what those current trends are with costs or not? The answer is it probably won't. And I want to give balance to both sides of the argument here. I think it's important to give balance, right? Because it's easy to sit here as a YouTuber and fully aware that people click videos that talk about doom and all of that sort of stuff and bad news. There's some crazy stat about 4 to 5 more people are going to click on a video that talks about doom to good news, right? That's why the news is full of bad news. By the way, I test this. I put out videos that talk about how to make loads of money, and I put headlines out that say, not we're doomed, right? But, you know, property prices coming down, however many percent. I would say it's about right. It's about 4 to 5 times as many clicks and views on the ones that are talking about bad news to how to actually make a load of money, which I think is interesting psychologically. But let's not go into it. I first talked about this scenario about 3 months ago, okay? And that is because of the lag in the system. And by the way, this slide that I got up now is taken from the minutes of the last MPC meeting. Because of the lag in the system and the length of time it's going to take for those interest rates to actually do anything, right? Because of the effect we're seeing now on the economy, unemployment, all of those sort of things, by continuing to raise, right, we're going to have potentially a massive issue next year. We're going to break the economy, and then we're going to see inflation undershoot and go into a deflationary period, which would then have to see us massively unwind this quantitative tightening and go into easing, but certainly bringing interest rates down very quickly. So with the latest split, there's the MPC will always have a balance of personalities on there. They want to get balance as well. So there is still a voice in there. I sadly can't remember her name. She's relatively new, very dovish in there, that is talking about this exact possibility that they don't want to continue to raise the interest rates because everything they need to have done could already have been done. And they now need to see how this pans out, because otherwise we could undershoot inflation in the next couple of years, go deflationary, and that would not be a good thing either. And actually, when you look at the ONS's own predictions in terms of what's going to go on here, when you look at the fan chart, the actual mid ground here, which is where they're predicting it to go, does actually undershoot the 2% target anyway, with the potential to go deflationary, right? And that is going into, when you look at it, into sort of 2024, 2025, into 26, we could just be dipping, so basically overshooting. So it's a very fine balance. So this is why the question is, have we peaked? Are they going to keep raising them? Or have they done enough? And should they keep it as they are? My gut feeling when I look at all of this is that all these committees, MPCs, markets are all very short term in how they look at stuff. They'll look at data and they'll make decisions based on the data they're seeing rather than the full projection of what's going to happen in 12, 18 months from the decisions they're making. So let's say we go into next month and we see inflation go up again. Will they then go, inflation's going up again, let's put interest rates up again, even though it's not going to make any blimmin' difference at all because of the lag to the system. Okay, and would inflation go up anyway, regardless of what they do in interest rates next month? Let's look at that in a second and ask that question. Right. Sorry, let me just find the right button to go back in. Now, this is why we need to understand how inflation is calculated on a rolling. How it is it's calculated on a rolling 12-month basis. So it is a year-on-year change, a year-on-year delta, if you like. So to get an idea of what's going to happen to inflation, we need to know two things. We need to know, number one, it's going to be this month. So like for the next inflation print, which will be in October, okay, October's inflation print will give us September's inflation, if that makes sense. So we're in September at the moment. The next inflation print, mid-October, will show the inflation in September. Now, that's comparing now, this September, to last September. So it's that rolling 12-month period. So you're going to have two factors to that. One factor is how much has it done month on month this September? And the second factor is what have it done month on month last September? Because that's now going to be dropping out of the data. if that makes sense. So right now, we could very feasibly be seeing quite a large month-on-month increase because of various factors, goods going up again, oil going up again, all of that sort of stuff. When we look at the month-on-month 12 months ago, it's the one highlighted and circled in purple there. I'll just get my eyes out. 0.4%. So if you look at, by the way, I always use, Frontier is saying, is this live or pre-recorded? This is live, my friend. I always do these live. You will see it on the pre-recorded, but this is live right now. I'll take that as flattering, by the way. I think it might be pre-recorded. So when you look at that CPIH, which I always use rather than CPI, because the ONS itself says CPIH, which is what the housing element included as well, is the most accurate of all of them. So headline figures, they tend to use CPI. I always like to look at CPIH. This time last year, it was 0.4%, which is not a massive increase. When you look at where we were last year, going into the peak of it, 0.4 is not a massive interest. So that's about to drop off. So if we're more than 0.4 this month, so last month, I believe we were 0.5. Let's have a quick look. Last month, we were actually 0.4. If we're more than 0.4 this month, chances are inflation is going to tick up again. I do not think it's beyond the realms of possibility that month on month, we're going to have more than a 0.4% increase with CPIH, which would put us going back up when the next print comes out. Now, if we go back up, will the MPC look at that and go, we have not solved this, we need to put another 0.25%. I can't see us going 0.5% anymore, but another 0.25% increase to 5.5 in their next meeting. That is a possibility on the quantum. Now, when you look at the next one after that, so 0.4, so if I use this, sorry, I need to put my glasses on. I can't zoom in on this. The October figure here is 1.6 month on month. So October 22 saw a 1.6% month-on-month increase in CPIH. That is a big, big spike up, big month-on-month increase, and that is when inflation peaked, you'd say. Of course, October 22 would have been released in November 22. So when you look at the figures, people say, look, it peaked in November. We will not see, or I think it's extremely unlikely, that we're going to see next month anything like a 1.6% increase month on month, which means we will probably see quite a sharp fall in the headline inflation. By the way, that will come out just before Sunak's pledge of halving inflation by December. So that print will come out in November. So October's print, I would imagine, might see a little tick up. Not definite, by the way. Those pulling factors, even with the oil filtering through the system and the goods going up, the other factors could well take it down. But I think it's not beyond the realms of likelihood. We'll see a tick up. November's print, right, which will come out, October's print, which will come out in November, we'll probably see quite a sharp drop. And at that point, people will go, done, we've solved it. The government will come out, Rishi will come out and go, we pledged to halve it by December 23. Look, we've halved it. Aren't we amazing? But then after this red line, look at the next quarter. The next quarter has a net 0.4% increase over those 3 months. So it's got a plus 0.4, plus 0.4, and a minus 0.4, not in that order. So you've got a quarter that quarter on quarter is only going up plus 0.4. So when we see the big drop off, if we do see a big drop off in November, we've then got a quarter of actually not a huge amount dropping out in terms of increase. So I think it's going to stick at that point, especially if oil is still going up and that's seeping through the supply chain. If that makes sense, by the way, give me a thumbs up, because I don't know if I explained that very well. But I feel we'll see a little tick, big drop, and then a stick, if not maybe a little bit more for a quarter as we go into the beginning of 2024. So I'm not sure if that makes sense. Give me a thumbs up. Somebody give me a thumbs down. Tough crowd. It's fine. Don't worry about it. So therefore, short-term possibilities, as I said, October 23, we could see a little rise in CPIH plus an interest rate rise potentially. Could we go one more, 5.25 to 5.5 next month? November 23, large drop, hit Sunak's pledge. Sunak high fives. We pause. December 23 to Feb 24, does it stay sticky because of what's dropping out, the 12-month rolling? What will happen to interest rates? Do we even see another little increase, right? If we go sticky for a quarter, maybe even see a very slight increase. By the way, you've seen America, inflation has gone back up again. France, inflation has gone back up again. whether that's short-term blip based on that 12-month rolling or not. If we have a quarter of stickiness, will we see that last little bit up? And then when we get past that into March 24 to May 24, that quarter, March, April, May, actually we see some quite large month-on-month figures in there. That's probably going to drop off unless we see a change in trend and some third-party input, like a supply shock, like a change in the Ukraine situation, like energy prices go up again. Let's say we have a really cold winter, right? And there's a big supply and demand issue. And I know we've got the energy price cap for October, November, December is set, but then we go into January, February, March. Could we see a spike? I'm not saying we will do, by the way. I'm just saying there's a possible third-party, not black swan, but third-party inputs that could put the inflation back up again. But with everything else staying equal, with utilities under control, okay, I would suggest we're probably going to see it come down quite quickly in that quarter, March 24 to May 24. Is that when, if we see some sustained and fairly rapid drops then, is that when interest rates might start to come down? So at the end of that period, summer 24, could we see another couple of increases up to then, and then it starts to come down? I don't know. There's a whole range of possibilities, right? Something else might come in, completely change the picture here, and inflation spikes again, and we go up to 6.5, 6.7. But we will peak at some point. Whatever the doom-mongers say, right? At some point we'll peak. But does it matter? This is the issue. By the way, I can see a lot of comments coming in. We're going to go to the comments in a little bit. Why are we talking about all this? Why does it matter? Because we want to relate it to the housing market. So let's do that now. Let's see what these possibilities will do with the housing market. And here's my personal view on it. So again, just to quantify, I do not want a mass meltdown of the property market. I do not want interest rates to carry on spiking and destroying returns. I do not want people to lose their homes. That's just not good for anybody. I'm a property guy, so I'm conflicted because the property I have, you want it to carry on performing. When we're in a market correction, there's also a lot more opportunity to invest in higher yielding, better property and add value. Right. So I would say we're in an accumulation phase right now. So that is also an opportunity. So it is an opportunity for people, but it's also bad if you also own property, right? So you take chances. I feel the property market is between a rock and a hard place right now. There's not a lot of short-term input, good news, right, that's going to stimulate much for the property market. Now, this might be a good thing, by the way, because I've said for a while, I actually think the property market does need to correct in terms of multiple of income to make it more affordable for people who are stuck in this horrific rent trap that they're in to get onto the market. And I do think it's a societal and sort of a human species ownership of your, by the way, I rent for various reasons. I invest the money rather than buy my own house. But I think people should have the ability to own their homes if they want to. So we're stuck between a rock and a hard place. And this is why I think that. The first rock, or the rock versus the hard place, is the inflation and the interest rates. So the longer inflation stays higher, the higher interest rates will go. Higher interest rates makes it more difficult for people who own property because their debt is more expensive. Let's just zoom back in. This is the CPI element. This is the owner-occupier housing element of the CPI print. This stuff in mauve at the bottom is owner-occupier housing costs. As I said, this snot green is the rental costs. So the bigger this gets, the more expensive it gets for people. The less they can afford, and just by definition, the least you can afford to borrow or service, the least property, the lower value of property you can buy, and that will drive property prices down. And if you have over leveraged, which a lot of people clearly have in the era of cheap debt, when the tide comes out, you see who's swimming in the ocean naked and all that sort of cliches. But we're seeing at the moment a lot of people, the tide is coming out, there's a lot of people swimming naked, and that will lead to people having to sell their homes more quickly if they can't afford the the mortgage payments, because they continue to go up and up and up and up. So this is the rock from the rock and the hard place. Just to remind you, this is the cost, the change in mortgage interest payments. We're spiking. It's probably going to be more than we've ever seen before. This is going to put a significant amount of stress on people who have over leveraged with their debt, right? And that will in turn cause more people to need to sell if they can't afford that debt as it gets more expensive to service, which will see property prices come down. That's the rock. Let's look at the hard place. So the hard place is recession. So how do you solve the problem of the rock, which is high interest rates? Sorry, not the problem. The problem is inflation, right? So to solve inflation, interest rates go up, and then interest rates could potentially tip us into recession. So it's almost the medicine, if you like, is causing this hard place now for people. So what happens if we tip into recession, which is now looking more likely? Property market, UK GDP are symbiotically linked, right? There is a correlation, psychologically speaking, that when we go into recession, people have less money, unemployment goes up, pay cuts, all of that sort of stuff. People cannot afford their mortgages. They have to sell. Conversely, right, actually, if property prices are going down, people have the perception of less wealth, therefore they spend less, and it actually tips into recession. And it's like it's a vicious circle. So recession is also not good for a property market. So really, the cure for inflation, which is the interest rates, which are making things very difficult for people, right, is then creating, well, so the medicine is the interest rates. The medicine is kind of poisoning the property owners. And then the cure, the recession, is just as bad for property. So both of these are not looking great for the property market right now, which is why so many people are asking when will interest rates come down? Because really, that is the thing that's going to bottom out the property market. As a homeowner, we need to know when interest rates are coming down, just to give some certainty, right? And to make sure we can afford that debt right now. So it's not even about trying to get a massive mortgage to go and get a big house, right? It's like, how can we afford our monthly debt payments? As an investor, it's important to understand when markets are bottoming out, because you don't want to be buying up here if it's coming down. We want to be accumulating at the bottom. So when's it going to bottom out? This is why people are asking, have we peaked? When will interest rates come down? Here's what I think. I think we're asking the wrong question. I think it's actually irrelevant when they come down. The real question we need to be asking is how far do they come down? So whether, I've said it for ages, whether we peak at 5.25, 5.5, 5.75, 6, the peak figure is not relevant. It's how long do they then take to come down, and where do they settle? And I want to, if you're new to the channel, I haven't talked about this for a month and a half, 2 months. I want to reintroduce you to this staff working paper from the Bank of England. It's extremely interesting read. I sort of flashed this in. It's kind of pages and pages of this mathematical equations. Very exciting if you're into this sort of stuff and want to read it. The point is, it relates directly the influence of interest rates on housing market prices. Okay, and this is the thing that really matters. This is the thing you need to take away. I'm gonna go in and read it. Last sentence, our results suggest that a 1% change in real interest rates, now real interest rates is inflation adjusted interest rates, that persisted could move real house prices by just under 20%. So I just want to read that again. So a real long-term interest rate change that is persistent, and it doesn't quantify what persistent is, could change the property market by 20%. As you know, if real interest rates go up over time and stick there, property market could come down in real terms by 20% for every 1% it goes up. Huge amount, right? Huge amount. When you take this modeling of the effect of interest rates, and by the way, if you want to read it, it's very interesting looking at how effectively global interest rates over the last 40 years have been in decline, right? Almost straight line down. Of course, there's been spikes, peaks and troughs, but generally decline, and asset prices have all gone up. And the theory of this is that pretty much all the passive asset price gains are entirely down to interest rates and people's affordability to borrow, rather than supply. Yes, there's going to be some inputs with supply demand, all that sort of stuff, but big picture, it's the interest rates that do this. This is theory, by the way. I'm not saying this is absolutely 100% correct. It's theory. This theory is then taken by Resolution Foundation, a think tank, put into a report called Peaked Interest, which shows, and this is now out of date because this is sort of done a couple of years ago, talks about two potential possibilities of what's going to happen with house prices. One is that interest rates drop off a cliff again after all this is over and go back to where they were sort of pre-pandemic, in which case we could be seeing asset prices, specifically house prices, spiking back up even further to where they were, to sort of 10, 11 times price earnings ratio. The more realistic outcome is this little red dot here, which is if interest rates settle in a new normal, which is a higher persistent new normal. Let's just say, for example, 3 to 4% as a new normal, right? We could see house prices settle at a 5.9 times price earnings ratio. Now, of course, as nominal earnings go up, it does mean that property prices could well go up as well over the long term. But real time, the actual value of something will be considerably lower. And if you look at the range of probabilities right now, I think pretty much everybody out there is suggesting that the main probability out of all the possibilities is that interest rates will settle higher than they were pre-pandemic, or even, so pre-pandemic, what? So, 0.5%, under 1%, right? The chance of it getting back down to that sort of level of interest rate is almost zero. So where do they end up? That is going to be the longer term driver of the UK housing market, I would suggest. Here is, by the way, I can't, if anybody can find me a graph of 10-year gilt yields index linked, so real adjusted. I can only find 30-year. I don't have sort of trading platforms and stuff like that. And this is also out of date, but you can see from here to here how much the 30-year real term, so index linked gilt yield is. And it's gone from, what's that? minus 2.5% to 1%. So that's a 3.5% increase, and this is a few months old. And I weirdly, and I'm just trying to work this through in my mind, as inflation comes down with interest rates staying high, right? Very soon we're going to be in a real time, potentially in a real time current interest rate that is above zero. So right now, interest rates still below inflation, which means we're in negative real interest rates, but that's going to cross over soon. And if it settles, for example, let's say interest rates settle at 3-4%. Let's just say they settle at 3%, and inflation settles at 2%. We then got a real interest rate of 1%, plus 1%. It's been sitting about between -2 and -3 for a long time. That's a 3% difference, right? So -2 to +1, 3% difference. And that report suggests that for every 1% change in real term persistent interest rates could see a 20% change in the housing market. So if they do settle at that sort of level, I do think we could be into a fairly significant real-time housing market correction. And if you look at this, I show this every time, it only comes out once a quarter, but this is real house prices, not the nominal. This is the real house prices. We can see how steeply those real house prices are correcting already. They're well below the average long-run line, the trend line, which suggests that in real terms, in terms of real value, houses are getting increasingly affordable. And actually, when you look at the nationwide, again, real time, they're actually starting to approach that 5.9 times. Now, the nationwide is lower as an indice than ONS and Halifax, for however their methodology works. So I think it's slightly more conservative in terms of house prices than the others. So I think the others have got further to fall. But if you're trying to sort of look at where we think the market is going to be bottoming, I think that's a good place to look. So when we start to see that real term house price sitting at that sort of 5.9 times, or 6 times, 5 to 6, it's probably everything swings, overswings, undershoots, overshoots. So it might go below that, but that could be where we start to see the UK housing market bottom out when we look at those charts. There we go, team. That's what I've got for you. Oh, no, I've got one more slide. So summary, recession, bad for house prices. If we go into recession, that's not good for house prices, especially if unemployment starts spiking up. High interest rates also is bad for house prices. So we are in high interest rates right now. If it carries on going up, that's bad for house prices. Rock hard place. High inflation equals larger drops in real house prices. Everybody talks about nominal house prices. Oh, it's being so resilient. Look at the ONS data, which is 9 months out of date. It's still not that much below the peak. It's 9 months out of date, and it's not inflation adjusted, right? So it's almost meaningless, but it fits a narrative. And there we go. Where it bottoms out, dependent on where interest rates settle. So when do I think interest rates are going to drop? Potentially, maybe start mid next year. Potentially. From where they drop, we don't know. I would say potentially another 2 quarter point interest rate rises might be on the cards. These are all barring in my taking out any third party unexpected factors, supply shocks, changes, geopolitical climate, all of this sort of stuff, right? Potentially it goes up a little bit more, starts to come down end of mid next year. But if it goes up a little bit more, I can't see it coming down. Let's say this time next year, we're still about where we are now. Then we're going to 2025. We're still probably going to be above 5 going into 2025. Although we could then see inflation drop off very quickly, and then it might have to ramp down fairly quickly. But it's all about where it settles. That's what matters for the long term of the UK housing market. That's what I've got for you today, team. What have you guys got for me? Let me see what questions we've got. I'm just going to bring my laptop over here so I can actually read them vaguely looking at the camera, if that's okay. Stuart started with best case scenarios, Table Mountain, rates held at 5.25 throughout most of 2024. Pound sinking, the Bank of Credibility have a credibility issue pushing rates below the Fed. November hike, I think. Cool, I think we're in agreement that one more before Christmas. And yeah, could well, even if it doesn't go up, it could stay level until, I think maybe mid next year, but we just have to see. Simon, don't think rates going down before 2025. So we've got mid next year possibility to 2025. I think it's also a possibility. These are all possibilities or possibilities on the probability quantum. Mark, Bailey only voted to pause after pressure from Sunak. He's shitting himself. The mess the country's in. Yeah, and look, I think that's kind of what I alluded to, Mark, isn't it? I think there's a narrative thing there by pausing to sort of get everybody to calm it down a little bit, almost trying to put a, hey, look, it's not as bad as it looks. And if we don't put it up, that if we carry on putting it up, people think everything's really bad and start panicking. We don't want to do that. We need to have a bit of mass control out there. So let's just pause the rate hiking for a little bit, and let people sort of chill on it. I don't disagree. Madeline, if you have an immediate decision like a refinance and just watching the Sonia market seems to be the best you can do. Longer term, Sonia never picks up on the big turning points. So it just seems a punt. Yeah, look, my view with Sonia is so reactive. I always think they go too reactive. I think the market goes, good news, they go too far one way. Bad news, they go too far the other way. All you can do is see what's out there at a time. If you're coming off, if you need a refinance, there's something to be said about knowing what you're going to be paying. So I've just fixed one on. I know it sounds weird. Like I was absolutely delighted. I think it's 8.8, 8.9. I put a video out about it this week. I'm delighted about that because I know that I'm going to be with that for 2 years. It's actually significantly below where it was on the variable, and I know the margin I make on that, so I'm happy. Simon, we effectively have 18 months to get our finance in order. Interest rate hikes, general election. Yep, that's an interesting thing. Sibit's looking rough out there. Yes, it is. Darren, Fred Mills, ST Samuels. Is that somebody who works for them, Darren? I don't know, Fred. 555 Frontier, I wish I could get a wage rise. Yeah, me too. 555, always. Sib, estate agent laughed 6 months ago and I mentioned big drops, not happy man now. We have a high-end estate agent area has gone bust. That's an interesting thing, looking at high-end properties. Crude oil at 90, plus 90 years, about 95 today. GBP USD is going down. Simon, you guys have some conversations, that's fine. Kathman, the Uber Hawk, there we go. Thank you for that, Stuart. Oh, Stafford, makes sense, focus your camera. Is it out of focus? Oh, it is a little bit out of focus, isn't it, now that I'm coming? That's frustrating. I don't know why that's out of focus. It's got should have autofocus on. Anyway, Sefkin, I'm trying to buy a property. It feels like sellers just ignore HPI from Nat Halifax or anything else, just not accepting reasonable offers. Yeah, there are some who are accepting, I would suggest. Cool. I think, so I'm just seeing if there's any questions. Darren from Suffolk got the white paper. Awesome, Darren. Happy with that. I'm just trying to work out why this is not auto-focusing. Sorry, guys. Don't know why it's not. Fame and fortune has to be another 2 rate rises to go. Just to let you know. Yeah, there we go. That's why I said potential 2 rate rises. I'm in agreement with you, Fame. Look, if my camera's out of focus, team. Nobody likes an out of focus camera. That sucks. I'm going to end it there because I don't want it to look really bad, and try and fix that. Must be a setting on the camera. I hope that was useful to have a look at. I will. I'm away for the next few days again. So next week we're going to October, don't we? And we're going to see the HPI. So we'll probably see nationwide beginning of next week, and then Halifax probably a few days after that. It'll be interesting to see the trajectory of the market, where it's going in terms of the nationwide Halifax. I would say if anybody's looking at the indices, Halifax seems to be the most correlated to the UK ONS figures. So I think that's the one I would put my hat on. Generally, is the Halifax in terms of the how much of a leading indicator it is for the actual figures we'll see in 6 to 9 months' time. But there we go. Hopefully that was useful. It's been a pleasure as always, team, and I will see you next week.